Have you ever looked at the Forbes list and wondered, how do the ultra-wealthy seem to multiply their fortunes year after year, while for many of us, just getting by is a daily challenge? It's a question that gets to the heart of a huge topic: income inequality in the United States. Today, we're going to break down some of the key ways the rich keep getting richer. It's not about magic, it's about a system. First, let's talk about assets. The wealthy don't just have bigger paychecks, they own things that make money for them. Think stocks, bonds, real estate, and businesses. When you own a piece of a successful company, you get a share of its profits through dividends. When the stock market goes up, the value of your portfolio soars. If you own apartment buildings, you collect rent every single month. These are called capital gains and passive income streams. While most people earn money by trading their time for a wage, the wealthy have their money working for them 24/7, even while they sleep. This creates a snowball effect, where their wealth grows exponentially over time. Next up is the power of investment. The saying "it takes money to make money" is incredibly true. With significant capital, you can access investment opportunities that are simply out of reach for the average person. We're talking about private equity, hedge funds, and venture capital, which often promise much higher returns than your standard savings account, or 401k. For example, being an early investor in a startup that becomes the next big tech giant can turn $1 million investment into a $1 billion fortune. The barrier to entry for these high-reward investments is a high net worth, creating an exclusive club where wealth generation is supercharged. Then there's the tax system. This is a complex and often controversial topic, but it plays a massive role. In the U.S., income from a job is often taxed at a higher rate than income from long-term investments. This is known as the capital gains tax. So, a CEO's multi-million-dollar salary might be taxed at a top-tier rate, but the billions they make from their stock portfolio increasing in value are taxed at a much lower rate. Wealthy individuals and corporations can also hire teams of expert accountants and lawyers to find legal loopholes and strategies to minimize their tax burden, allowing them to keep more of their earnings to reinvest and grow. Another crucial factor is influence. Immense wealth often translates into political and social influence. The wealthy can fund political campaigns, support think tanks, and lobby for policies that benefit their financial interests. This could mean advocating for deregulation in their industry, pushing for lower taxes on investments, or shaping laws that create a more favorable business environment for them. This isn't necessarily a conspiracy, it's simply a dynamic where economic power can shape the rules of the game, creating a feedback loop that further benefits those at the top. Finally, let's consider generational wealth. Fortunes aren't just made, they're passed down. Through trusts and estate planning, massive amounts of wealth can be transferred from one generation to the next, often with minimal tax impact. This gives the next generation a monumental head start. They inherit not just money, but assets, businesses, connections, and a financial education that sets them up for continued success. This creates dynasties, where wealth accumulates and consolidates within the same families over decades. Understanding these mechanisms isn't about pointing fingers or feeling discouraged. It's about being informed. Knowing how the system works is the first step toward having a meaningful conversation about fairness, opportunity, and what a healthy economy looks like for everyone. What are your thoughts on this? Let me know in the comments below. Thanks for watching, and if you found this breakdown helpful, be sure to like and subscribe for more content that makes sense of the complex world of finance. See you next time.